What would happen if you invested $100 monthly for 10 years? Most people believe you need thousands of dollars, a financial advisor, or a lucky break to build wealth. But that's a myth. In reality, the difference between being stuck financially and building serious long-term wealth often comes down to one simple habit: consistently investing small amounts over time. This video breaks down exactly what happens if you invest just $100 per month. No more, no less, for the next 10 years. The results may shock you. We're not talking about gambling on crypto or hoping for viral stocks. We're talking about using time, compound growth, and discipline to turn modest money into meaningful wealth. If you've ever thought investing isn't for you, or that $100 isn't enough to make a difference, this video will change your mind. 1. Understanding the power of compound interest, extended. Before diving into specific numbers, let's look at the secret weapon of long-term investing: compound interest. It's not just a financial term. It's the single most powerful force in building wealth. Albert Einstein reportedly called it the eighth wonder of the world. Here's how it works. When you invest $100 and that money earns interest, the next time around you're earning interest on your original amount plus the interest it already generated. Over time, this creates exponential growth. In year 1, your $100 monthly investments might grow slowly, but by year 5, the interest you're earning every month starts to snowball. By year 10, a big portion of your final total won't come from the money you invested. It'll come from the interest on your interest. That's what makes compounding so powerful. It rewards discipline, not just capital. Even small investments become significant with time. The longer you stay in the game, the harder your money works for you. It turns patience into profit and consistency into wealth. Time, not talent, becomes your biggest ally. The math. What $100 monthly looks like over 10 years. Extended. Let's break it down with real numbers. If you invest $100 per month for 10 years, that's $1,200 per year, or $12,000 in total contributions. Now let's apply 3 different scenarios based on typical market returns. At 5% annual return, very conservative, you'd end up with around $15,500. At 8% return, average historical S&P 500, you'd have nearly $18,300. At 10% return, optimistic but realistic, you'd finish with around $20,500. In all cases, you're gaining thousands above what you put in, and this is without needing to increase your monthly contributions. More importantly, your money starts working for you. And remember, this calculation doesn't include dividends or reinvested gains, which can push returns even higher. The earlier you start, the more runway you give compound growth. It's not about how much, but how long. That's why small, consistent action beats waiting for a perfect time. 3. Where to invest your $100 monthly, extended. If you're serious about starting, the next question is, where should that $100 go? Here are the most effective and beginner-friendly options. Index funds. These track the overall market and have historically delivered steady returns, around 8 to 10%. Funds like VOO or VTI are popular, low-fee options. They're diversified and require little maintenance. ETFs, exchange-traded funds, similar to index funds but tradable like stocks. They're low-cost and ideal for beginners who want exposure to tech, healthcare, or global markets. Robo-advisors, platforms like Betterment or Wealthfront, allow you to automate investing with minimal fees. You answer a few questions, and the system builds a portfolio suited to your goals. Dividend reinvestment plans, DRIPs. These let you invest in dividend-paying companies and automatically reinvest earnings, compounding your growth further. No matter where you invest, the goal is to stay consistent, keep costs low, and avoid emotional decisions. The platform matters less than your commitment. What counts most is automation, patience, and letting compound interest take care of the rest. Simplicity outperforms complexity over the long run. 4. The psychological benefits of consistency, extended. Investing isn't just about numbers, it's also about mindset. When you commit to investing $100 each month, you begin to shift your financial identity. You start thinking long-term. You begin to understand patience. You take ownership of your future. This psychological shift has ripple effects. You become more disciplined with spending. You learn to delay gratification. You begin to make smarter money choices in other areas of life. Not because you're sacrificing, but because you now understand what your money can become. Consistent action builds confidence. Every monthly contribution becomes a quiet vote for the person you're becoming. Someone who plans ahead, takes control, and makes intentional decisions. That's how real wealth begins, not in your portfolio, but in your mindset. Belief fuels discipline, and discipline fuels success. 5. What if you increased contributions over time? Extended. Let's say you start with $100 a month, but after a few years you begin increasing that amount. Maybe you get a raise or cut back on unnecessary expenses. What would that look like? If you increase your contributions by just $10 per year, starting with $100 per month in year 1 and ending with $190 per month in year 10, your total contribution becomes around $17,400. At a modest 8% return, that would grow to nearly $24,000 to $26,000 in 10 years. This shows how even small increases can supercharge results. It's not about jumping from $100 to $500 overnight. It's about scaling gradually in sync with your income or lifestyle. Small, consistent steps beat occasional giant leaps, and each increase builds financial momentum. It's like adding fuel to a fire that's already burning. As your habit strengthens and your income grows, those small upgrades create exponential outcomes. Growth becomes automatic, not accidental, and wealth becomes a lifestyle, not a struggle. Avoiding the common pitfalls. Many people fail to stick with investing, not because they don't have enough money, but because they make one of these common mistakes: trying to time the market. Waiting for the perfect moment to invest often leads to never investing at all. Stopping when markets drop. Volatility is normal. It's not a sign to quit. It's a sign to keep going. Overcomplicating strategy. Chasing hot stocks or trends can hurt you. Simplicity wins over time. Not automating. Forgetting to invest is easy. Set it and forget it. Automation removes emotion and builds discipline. By starting with $100, you're lowering the barrier to entry. There's no need to be perfect. Just be consistent and calm. Over time, the results will speak for themselves. 7. What happens after 10 years? So you've invested $100 per month for 10 years. You've built momentum. Now what? The next phase is where things really accelerate. You're no longer starting from zero. You now have a foundation, a portfolio that's growing on its own. If you stop contributing, your investment keeps working. But if you continue or even increase your contributions, you could see exponential results in the next decade. In 20 years, $100 a month at an 8% return becomes $55,000 plus. In 30 years, it's over $135,000 from just $36,000 of contributions. And if you increase to $150 a month, you're looking at over $200,000 in 30 years. That's the power of long-term consistency. The work stays the same, but the results multiply. It's not about getting rich quickly, it's about building real wealth, quietly and surely. The most underrated wealth strategy. $100 may not seem like a lot, but over 10 years it can change your life. Not because of the amount, but because of the habit it creates, the mindset it develops, and the wealth it builds over time. In a world obsessed with quick wins and flashy gains, this approach stands out. Steady, boring, consistent, and incredibly effective. You don't need to be rich to start investing, but you do need to start investing to become financially free. If this video helped you see investing differently, like the video, drop a comment, and hit subscribe for more insights that help you build a stronger, smarter financial future. Because wealth isn't built in a moment, it's built one $100 decision at a time.